Hello, this is capital budgeting part two. This is the continuation from the video part one. Now, so in our last class, we discussed uh, at least four capital budgeting techniques, and one of them is internal rate of return. Just to recap, there are those four techniques are uh, basically a payback period first, and second, net present value, third, internal rate of return, and then fourth, profitability index. Now, we discussed payback period method and net present value last time in the last video. So, and we also briefly touched on the internal rate of return. Actually, we more than touched on the internal rate of return. We discussed at length and fully what it means and how it is defined. So actually today, what we need to do is the Excel exercise of internal rate of return. Now, so if we briefly recap what we discussed last time, or how we define internal rate of return, it's basically we defined it in terms of discounted cash flow model, and I explained to you it's the discount rate that equates the right-hand side of the equation equal to the left-hand side. And think about it. What is the left-hand side? That's the left-hand side is cash flow at time zero, which is basically initial investment. And the right-hand side is what? The cash flows in the future, right? Which are basically cash inflows, right? The cash flows that will be generated from the from this project, right? So as I explained last time, there are three possibilities for this equation, right? I mean, in terms of the equality between the left-hand side and the right-hand side, there can be three possibilities. One, the right-hand side can be greater than the left-hand side. Two, both sides are equal. Three, the right-hand side can be smaller than the left-hand side. Now, of course, if the right-hand side, which is basically the present value of all the future cash flows, projected future cash flows, right? If that right-hand side is greater than the left-hand side, that's what we want, right? Isn't that right? Because that means the cash flow generated from this project and its present value is greater than the initial investment. So who wouldn't want to generate greater cash flow from the project than its initial investment, right? That's basically the reason you're investing in a project. Now, and of course that means, if the right-hand side is less than the left-hand side, then that's not desirable because you're not even getting your investment back, right? But if both sides are equal, that means in terms of present value, right, your project simply breaks even. and which may not seem very plausible, or which may not seem very compelling to accept a project like that. But at least this means, your project breaks even, right? Of course, you would, if you can choose, definitely you would choose the projects whose right-hand side is greater than the left-hand side. Now, but I also explained, if the right-hand side is supposed to be equal to the left-hand side, then it can happen only under one condition, meaning that the discount rate, there would be only one unique discount rate that would make it possible, right? Depending on what the discount rate would be, the right-hand side can be greater than, or less than, or equal to the left-hand side. So there can be potentially multiple discount rates that can make the right-hand side greater than the left-hand side. Or there can be also multiple values for discount rate that can make the left-hand side greater than the right-hand side. But think about it. There can be only one single unique value for the discount rate that can make both sides equal. Okay? And when that discount rate is found, that discount rate is called internal rate of return. Okay? So if the right-hand side is equal to the left-hand side, the net present value is automatically zero, because net present value is the right-hand side minus the left-hand side, right? So the decision rule for, if you use internal rate of return method, of course, if internal rate of return is greater than the cost of capital, then you accept the project. If internal rate of return is less than the cost of capital, then you reject the project. Now, the cost of capital, I repeatedly said it over and over, that's another name for discount rate. But then think about it. As I said before, right? There can be only one unique single rate that can make the right-hand side equal to the left-hand side. And then if internal rate of return is equal to the discount rate, I mean, in other words, if we found a discount rate that makes the right-hand and the left-hand side equal, then that's internal rate of return, right? By definition. Now, but if there are times, as I said, depending on what this value would be, the right-hand side could be greater, the left-hand side could be greater, right? So basically, consider this discount rate. And so think about it. If we have internal rate of return that's equal to cost of capital, then it's not shown on this slide, but what does that mean? That means the project just breaks even. And if it is a standalone project, you can accept or reject project based on this rule. But if there are multiple competing projects or mutually exclusive projects, of course, the decision rule is the project with internal rate of return greater than the other is the one that is chosen, right? So let's go to Excel example here. We have the slide shows how it is calculated, but the slide is not very uh, uh, the slide is not very accurate. Uh, the methods described in the slide is called trial and error method. You will have to, uh, in other words, you'll have to plug in a couple of possible candidates and using some guesstimates, right? And then try to narrow down the margin, and then eventually zero in on the correct internal rate of return, which is actually not very uh, which is time consuming and not very efficient, because if you have to go through a trial and error, that's already very crude method, right? So we're not going to follow the method used in the slide. Because it's a lot of, it involves a lot of guesswork. We're going to go straight to the Excel and use Excel's internal rate of return command. Okay, so let me switch to Excel and also switch that to on the. So I'm going to have to let me go and stop sharing, and then I'm going to share the Excel. Okay, now we have Excel here. So let's see how we can, using the example we used in the previous video, right? You see this model. So let's see how I got the internal rate of return. So it's basically finding the discount rate. And there are two ways you can do that. One, so in this example, the cash flows are like this, right? Negative 850, and everything is in thousand, right? Okay. So that's the initial investment, right? And the cash flows, projected cash flows are like this from year 1 through year 5. Now, and then normally you would, when the cash flow, projected cash flows are presented in a column like this, the best thing you can do is use internal rate of return command. So internal rate of return is basically IRR, right? So you can actually, after equal sign, you can type IRR and it's going to pop up like this. And you just, then all you need to do is just enter, highlight that contiguous range of input data, right? Which is, which are cash flows, and then close parenthesis, and enter. Okay, and it gives you 9.95. Now there's a way we can verify that, right? And simply by using rate command. Okay. we can also confirm the same. Thing. Now, so I basically there are two ways you can do that. As I said, if you already know the command for that function, you can directly type it in, or let's say you can also search for that function, right? So if you go to this function symbol there, that f of x, that's the mathematical symbol for function, right? That means function of x, right? So if you click on that, and this dialog box opens up, and in this dialog box, the most recently used functions are shown first, right? But you wouldn't find it there because this is most commonly used functions. And if there's a specific function that you are looking for, you'll need to go to its categories. Since we are in financial category, you got to go to the financial and then scroll down. It's in alphabetical order, so you scroll down until you find IRR, right? Internal rate of return. So click OK. And all you need to do is just click on values and highlight the range of the input data, right? You don't need guesswork because we don't need to guess. Already this function will automatically give you the solution, the accurate solution, so you don't need to take any guess, right? So then hit OK, and we got that. Okay. Now here in rate function, right? Again, you can type in rate, but also you can also, go to a function and go into the financial category and scroll down until you find rate. Okay, and then click OK. Now then you'll have to input the required variables, right? First, end periods. So there are 5 periods here, right? 1 through 5, right? Actually, you might wonder, isn't there 6 periods? No, it's 5 periods. Why? 0 is the beginning, right? Beginning of year 1. 1 is the end of year 1 or beginning of year 2. So that means 5 is the end of year 5, right? Or the beginning of year 6, but we don't have year 6. So it's only 5 years, right? So the total number of periods is 5. So you enter that. Payments. Now, the payments are cash flows in each year, and it's $60,000 every year. So you enter B4. You might wonder, what about B5, B6? You can enter B5 or B6, but here's the thing. This rate function can be used only if the cash flow generated, cash inflow generated is an annuity form, right? You remember what annuity is from the Finance 100, right? Annuity is a cash flow in constant amount at regular interval, right? So it is only possible because we have this cash flow stream is in annuities. If it is in irregular amounts, we cannot use it, right? We cannot use this function. Also, this is annuity because these regular amounts are paid at regular interval. If it is sporadic or it's not at regular interval, you cannot use it because it's not annuity. But fortunately, it is annuity. And then you enter present value. Present value in this case is the initial investment, right? And once again, initial investment is cash outflow because just like the making a deposit in the bank, and when you're making a deposit in the bank, it's like investing in a project, isn't it right? Because you are blindly putting your money into the bank, but what does the bank do with that money? They will invest it in some projects, right? So if you knew what projects the bank is investing in, right, you would be more selective about putting your money in a bank. But, well, putting money in a bank is basically a blind trust, right? So anyway, making a deposit is like still a cash outflow from you, right? So this is cash outflow, right? So that's like present value, right? And we have, it's asking for future value. Yes, future value, but this is not the future value. Think about it. Uh, the pure future value is only $1,000, right? Isn't it right? Because $60 is the annuity in the year 5, right? So to isolate pure future value, you would need to subtract, right, one annuity from it, right? So that would be the future value. And type means, either ordinary or annuity due. Now, from Finance 100, I hope you remember still the difference between ordinary annuity and annuity due. Well, ordinary annuity is the case where you make the deposit or payment at the end of each period, right? So then, over 5 years, there will be only 4 compoundings going on, right? Because the first deposit is made at the end of year 1, and until the end of year 5, there are 4 years, and the first deposit will get compounded 4 times, right? The second deposit will get compounded 3 times, and so on. The last deposit doesn't get compounded at all, right? And the annuity due is the case where you make the deposit or payment at the beginning of each period. And then think about it. The first deposit will then get compounded 5 times, right? Second deposit gets compounded 4 times, and even the last deposit gets compounded or earns interest once. So if the difference between ordinary annuity and annuity due is that annuity due has exactly 1 more compounding than ordinary annuity, right? So anyway, that's the review of Finance 100, the material annuity, which is the material from Finance 100, or Principles of Finance. Now, so in this case, and I told you always, ordinary is the default unless otherwise specified by the problem, unless the problem specifically states that the annuity it follows annuity due. It is always assumed as ordinary annuity by default. And also in this case, In this example, by the context of this problem, right? By the context of this example, it is obvious that it is ordinary annuity. Why? Look, this $60,000 cash flow cannot be made at the beginning of year one. It is made at the end of year one. You cannot have cash inflow the minute you make the investment, right? So it is ordinary annuity by default, right? And by also context. So when you type means, as I said, ordinary or annuity due. So if it is ordinary annuity, you enter 0 or just leave it blank, right? If it is annuity due, you enter 1. And what do you think that 1 means? That what means, there is, I told you, there is one more compounding, right? The difference between annuity and annuity due is that there's one more compounding, right? Annuity due has one more compounding. That's why you put 1 there if it is annuity due. But since this is ordinary annuity, you just leave it blank. And you don't have to guess. It already gives you accurate result, right? So then you hit enter and you get this. So we got our internal rate of return. Now, in this example, this is a special example. Why? Because in this example, the future cash flow is all even. In other words, it's always regular amount. That's why it is annuity. So this is more like a bond, right? If you think about the bond, right? Bonds, for example, bonds pay you, right, interest until the end of the maturity, right? That constant interest, right? And at the end, it pays you full face value of 1,000, and the last interest, right? Last annual interest. And this initial investment is like the purchase price of the bond. So, so this exactly fits the picture of the bond, cash flow in bond. But let's say you're investing in a project, right? And the future cash flow may not be even. It could be all, uneven, right? So if the cash flow is not uneven, if the cash flow is uneven, we cannot use this function. We'll have to then use only internal rate of return function. Okay. So let's try another example that has, uneven cash flow. And in this example, let me clear it out. And then clear out all the, let me put highlight. You remember that what is the meaning of that highlight? Yellow highlights are primary solution cells, right? So I'm gonna put the highlights there. Okay, to indicate that these are the solution cells. And also, I want to clear that out. And just to make it more interesting, I'm going to add a couple of more rows, right? Oh, I'll have to insert below. Insert below, right? I'll have to go to insert. I'll insert it here, right? Okay, insert, because it inserts below. And then 2, 3, 4, 5, year 5, right? I mean, just for the sake of experiment, you can add more rows, but that's fine. 5 years. And let me just for the sake of the format, right? It's in dollars, right? To keep that format, I just copy the cell above, and I will change. Let me change the values there. Now it's year 4, 3,500. Year 5, 2,500. Let's do it this way. Now, first, finding present value. Okay. Let me do this also. Let me just and then just like the to make it consistent, just like the previous example, let me keep the consistent label. Okay, and then just like before, and since we built it already here, right? Oh, now let's do this again. All you need to do is present value, right? And of course, the present value is in your at time 0 is the same thing. You don't have to do anything, right? But just to keep the formula consistent, let me do this, right? Now think about it. I'm discounting it, and you might ask, it's already time 0. Why do you need to discount? It's already, in present value. Yes, it is in present value, but it doesn't hurt, right? Because anything raised to 0 will be 1, so it's going to be just, itself, right? B18. But then the benefit of that is when you drag it down, it gets automatically copied, right? So the formula will be automatically copied. And there is consistency in formula, right? Now then, the net present value is the auto sum, right? If you take the auto sum of that, yeah, that's the net present value, which is, great, right? Highly positive. And if you take the, now these are all irregular cash flow, right? In irregular amounts. So we'll use internal rate of return, which is, IRR. And just highlight everything. There you go. That's so wonderful, very high. That's very high internal rate of return, right? Very high return, right? That's now our next question is, So think about it. This is not the total return. This is annualized return, annualized. So if annually 31%, almost 32% over 5 years, what do you think it's going to be? We can do a little thought experiment here. Over 5 years, you might think, oh, that's 31.88% times 5. No. You're in corporate finance and you are finance majors, right? And as a finance major and being in corporate finance, that means you have already done principles of finance, right? Then you know it doesn't work that way. If this is the annual return, right? The total return in 5 years will be 1 plus this raised to 5. It gets compounded, right? So anyway, we're gonna this is profitability index, but we're gonna come back to that later. But I want to briefly go back to the slide and discuss something that was probably left unexplored. So let me stop sharing Excel and go back to okay. So you see the PowerPoint now. So in this PowerPoint, my question is, so think about it. If we defined internal rate of return as the discount rate that makes the right-hand side equal to the left-hand side, right? How can so for this equation to always hold, right? The discount rate has to be exactly the internal rate of return, right? For this to hold, right? For this equation to hold. And if this equation is, if the right-hand side is greater than the left-hand side, that means the discount rate would be lower, a smaller number than when it is equal, right? And vice versa. When the left-hand side is greater, then the discount rate is greater than IRR. So then how can IRR and discount rate be how can they be different? I mean, what causes them to be different? Well, once again, think about it. IRR is the rate we find by solving this equation for the discount rate, right? So in other words, in this situation, the discount rate is not known, right? It is the unknown. That's why we're trying to find it, right? Now, but in most cases, think about it. The discount rate is known. Why? What is the discount rate? Discount rate is the prevailing interest rate in the market. That's how it is broadly defined. But what that means is actually what does the prevailing market rate mean? Let's go back to principles of finance, and let's go back specifically to the bond. if you remember, from the bond, right, we used the discount rate in the bond to discount. The discount rate we use is roughly defined as the prevailing market rate. But what is the prevailing market rate? We defined it at the time in principles of finance. It's the average interest rate or return that the bonds of the same risk class are paying, right? In other words, if your bond is triple B bond, right, you're holding triple B bond, and to price the bond, you need a discount rate. And what's the discount rate? On average, what other bonds of same triple B class are paying, right? The average that of what other triple B bonds are paying. In other words, the bonds of the same risk class, right? Now, prevailing market rate cannot be just wild number. Now, before you learned about the bond valuation, um, prevailing market rate was simply defined as the average return you can earn from the market, right? So what is that then? That's very vague. It could be the CD interest rate, the return on the CD, or just the bank interest rate, or. But then that's too vague. Think about it. If your bond is double A class, that's highly safe bond, right? And a highly safe debt instrument doesn't have to pay high interest because of the safety, right? They can pay low interest, right? Low means what? Lower than single A. And single A can pay lower than triple B. Triple B can pay lower return than double B. Make sense? And of course, triple B and above are the investment grades. So before learning about the bond valuation, that was just how it was defined, just broadly, or it was also defined as an opportunity cost. An opportunity cost to this investment project. In other words, if you didn't put your money into this investment project, right, or into this bond, what would be the best alternative, right? So, and then think about it. In case of bond, if you didn't put your money into this AAA bond, right, of company X, then your alternative, your next best alternative would be putting your money into another triple B bond, right? And if you're a little more, venturing out, if you're a more, risk taker, right? You would venture out into a more risky category, whereas you will notch up your risk and go into double B even, right? If you're, if you're pushing up, if you're pushing your risk tolerance. But again, that would be the next best alternative, right? If you're willing to push the envelope of your risk. But then, assuming that your risk tolerance is constant, meaning that you will still stay within triple B class, or better, like, single A, right, which is safer but lower return, right? But you don't want lower return, but then you would stay within triple B category, right? So the point is, um, because you're using the average of the prevailing market rate, which is the average of what other bonds or projects of the same risk class are paying, right? Your discount rate is already determined, right? So that's why this can happen. That's why your internal rate of return can be greater than the cost of capital, or it can be less than the cost of capital, right? So what does this mean? If your internal rate of return is greater than the cost of capital, that means your project is giving you a higher return than the average projects of the same risk class, right? Make sense? So that's why you accept it, because the return from this project is greater than the return from average other projects of this the same risk class. Make sense? Okay. Now I'm gonna stop this PowerPoint and then go back to Excel. Okay, let me share Excel. Okay, so back here. So now you see this is our internal rate of return. And think about it. What is this K? Right? What is that? Cost of capital. Now think about it. These rates are all on annualized basis, right? And your cost of capital is only 8%, but your internal rate of return is almost like 4 times, right? 4 times that, cost of capital. That means your project that you're investing in is giving you 4 times higher return, right? 4 times the average return of the average projects of the same risk class. And why would, I mean, is there any reason why you wouldn't accept this project? No, definitely, that's why. Okay, now, but if suppose this is much higher, like 18%, try 18%. Still, of course, internal rate of return is, of course, present value is still significantly positive. But suppose we have 38% as the cost of capital, which is very high cost of capital. Of course, you would reject this project and you reach the same conclusion by net present value as well. Right? Makes sense? You reach the same conclusion. Okay. So, and let me go back to the PowerPoint. All righty. So now we have pretty good understanding of internal rate of return. We did the examples. There's something called net present value profile. A project's net present value profile is a graph of its net present value versus the cost of capital. It crosses the horizontal axis at the internal rate of return. Yes, what this means is, oops, I'm sorry. See, the horizontal axis is the level of cost of capital, right? So if the cost of capital is 0, right? Think about it. Your net present value would be infinite, right? If the cost of capital is 0, then it's like, there's no discounting going on, because it's in the denominator, it's always 1 plus 0, so it's 1 raised to 1 raised to 2. It's always 1. So everything is, all future cash flows are not discounted, right? It's all, as it is, it's all present value. And then, so the net present value would be uh, uh, not infinite, but, very large, right? As long as, it's giving you a decent amount of, positive uh, future cash flows, then it would be greater than the total of that will be greater than the initial investment. So now, and then as the cost of capital moves up, right? The horizontal axis, going across horizontal axis, is actually the cost of capital moving up. Then at some point it will be equal to internal rate of return. And when it is equal to internal rate of return, what does it become? The net present value. So the vertical axis represents the net present value. So when internal rate of return is equal to cost of capital, then net present value is 0, right? Because they break even, right? In terms of present value. Okay. So that's what is called, net present value profile. Now, another example. We're not going to do other problems, but here's, some problems with internal rate of return method. Sometimes there are multiple solutions, right? Why? Unusual projects can have more than one internal rate of return. Why? Because, nth order equation, right? If you're, mathematically, if the, in an nth order equation, even think about it, second order equation, right? Or quadratic, there can be 2 x values, right? Third order equation, 3 x values, right? Now, and so in odd number, if the order of equation is in odd numbers, right? There will be, positive. There can be, just theoretically, there can be positive, positive internal rate of returns and negative internal rate of returns. And if it is, even the order of equation is, in other words, this n. If it is, even number, then, hypothetically and theoretically, it can have even number of positive solutions and negative solutions, right? But the number of positive internal rate of returns depends on the number of sign reversals to the project's cash flows. So you remember, if you have a long-term project, right, like 10 years, 15 years, right? Remember, negative cash flow doesn't necessarily happen only at time 0. At some point later, there can be another infusion of capital or another investment. Why? Maybe in year 7, you can expand your production capacity. And to expand the production capacity, you will need to make additional investment, right? And then there can be another, in year 11, another expansion, or, so the sign reversals, right, depends on the project's cash flows. Normal pattern involves only one sign change. Yes, because normally just at the beginning, right? In year one or at time zero or at a time one, right? Negative, right? Cash or cash outflow, right? And also the second problem is the basically internal rate of return method implicitly assumes cash inflows will be reinvested at the project's internal rate of return, which is usually the case actually, right? Because if there is, if you're a long-term investor, right, the cash flows, you don't necessarily, expect the net cash flow to be paid out, right? Those cash flows are expected to be reinvested into the project, right? So in the long run, you will recoup a higher return, right? But the assumption is this cash flow is reinvested at a constant internal rate of return. In reality, this rate of return actually each year that it is, the cash flows will be reinvested, but the rate of return may not be always the same as internal rate of return, because actual rate of return would depend on the growth rate of the income, the growth rate of the business, the sales revenue each year, right? Actual growth rate of sales revenue each year. Internal rate of return was just calculated mathematically for the convenience, right? And so it's like an annualized return, projected annualized return. So the actual annual return could be different, right? For projects with extremely high internal rate of returns, this is unlikely because why? This is in economics, in microeconomics, simple explanation for that. Why? Diminishing returns to scale, right? You cannot grow at extremely high rate forever, right? Diminishing returns to scale, right? Now, but these are rarely of practical concern, right? Now, as we compare internal rate of return and net present value, NPV and internal rate of return do not always select the same project. Yeah, they generally do. Sometimes they select, different projects in mutually exclusive decisions. If there's a conflict like that, net present value profiles if net present value profiles cross in the first quadrant, right? The first quadrant means if we go back to this, right? Let's see if we draw an imaginary vertical line here, right, or y-axis, and let's say y-axis, in this case, this is y-axis. Why? This is 0, not only in terms of net present value, but also 0% in horizontal axis, right? So if you extend this horizontal line, then that would mean what? Negative returns, right? Or negative cost of capital. Of course, you don't have negative cost of capital, right? That can't be, nobody would discount with a negative discount rate. And if you, that would, if, only under deflationary assumption, unless it is under deflationary assumption. Now, so this is basically first quadrant, actually, right? This is first quadrant. And that's usually where you would find the internal rate of return and cost of capital to be usually the range of those to be found. And NPV would normally be located in the first quadrant. And in the event of a conflict, of course, NPV method is preferred. Okay, so now we're almost out of time, so we'll need to continue with the rest of the topic in the next class. All right. That's it for today. Thank you for joining the class. Thank you. This is the end of the video.